5.99%. That's the number. That's the number Wall Street didn't expect to see again so soon. That's the number millions of Americans, their earnings were told, might not return until far into the future. For the first time in years, the average 30-year fixed mortgage rate in the United States slipped below 6%. On the surface, that sounds like relief. It sounds like the system correcting itself. It sounds like a green light for buyers who've been sitting on the sidelines, watching rates climb, prices soar, and opportunities slip further away. But here's the part that should make you pause. When mortgage rates fell below 6%, housing affordability didn't meaningfully improve. Monthly payments barely moved. First-time buyers didn't suddenly flood back into the market. In many cities, prices didn't fall at all. In some places, they kept rising. That shouldn't happen. In a normal housing market, lower mortgage rates act like a release valve. They pull demand forward. They restart frozen transactions. They restore balance. For decades, Americans have been taught that when rates fall, housing wakes up. This time, it didn't. And when the most powerful lever in American housing stops working the way it always has, it tells us something important. Not about real estate, about the financial system underneath it. Because the real story behind mortgage rates falling below 6% isn't about buyers or sellers. It's about money, where it's flowing, where it's quietly retreating from, and why that movement matters far more than the headline number itself. Mortgage rates didn't fall naturally. They didn't fall because inflation suddenly disappeared. They didn't fall because wages surged or because housing supply finally caught up with demand. They fell because enormous pools of capital were redirected back into the mortgage market. Quietly, deliberately, and almost entirely outside the public conversation. Hundreds of billions of dollars flowed into mortgage-backed securities, absorbing risk and pushing yields down. These weren't ordinary households refinancing. They weren't small banks chasing growth. These were institutional players moving defensively. That distinction matters, because defensive capital doesn't chase opportunity. It seeks shelter. When global money becomes nervous, it doesn't run toward innovation, startups, or long-term risk. It gravitates toward assets backed by governments, legal frameworks, and the implicit promise of stability. Mortgage bonds tied to American households fit that description perfectly. But here's the uncomfortable part. These buyers aren't betting on housing strength. They're betting on intervention. They're betting that the USALM system will not allow disorder, that liquidity will be provided, that stress will be smoothed over. That's not confidence in growth, that's confidence in control. And that's why mortgage rates fell even as the housing market remained fundamentally broken. Prices stayed elevated because supply is still locked. Affordability stayed crushed because incomes haven't caught up. Transaction volumes stayed weak because millions of homeowners are trapped in old, lower rates and refuse to move. What changed wasn't demand. What changed was capital behavior. Money moved to protect itself. And history tells us that when capital starts behaving this way at scale, it's rarely a sign of strength. It's a sign of late-cycle stress. This pattern isn't new. It's repeated across centuries, across empires, across financial systems that believed they were different. In the late Roman Empire, capital stopped flowing into trade and productivity and instead crowded into land and state guarantees. In pre-revolutionary France, money abandoned private enterprise and piled into royal debt. In multiple historical cycles, yields fell not because growth was accelerating, but because safety was being priced at any cost. At first, these moments always feel calm. Interest rates drop, markets stabilize, policymakers declare success. The public breathes a sigh of relief. But beneath the surface, something fundamental shifts. Capital stops rewarding productivity and starts rewarding protection. Markets become dependent on support. Volatility is suppressed, not resolved. The system slowly loses its ability to correct itself naturally. That's the phase the U.S. housing market has entered. Mortgage rates below 6% aren't a sign of healing. They're a signal that the system requires continuous intervention to function, that the old mechanisms no longer work on their own. And systems like that don't collapse overnight. They don't announce themselves with dramatic headlines. They unwind gradually, then suddenly. There's a sequence to this, and we're already deep into it. First came the rate shock. Mortgage rates rose faster than at any point in modern American history. That locked homeowners in place and froze inventory. Then came price rigidity. Demand weakened, but prices didn't fall. Sellers waited, builders slowed, supply stayed constrained. Then came intervention. When the market refused to reset naturally, capital stepped in. Mortgage bonds were absorbed, rates were guided lower. That's where we are now. But lower rates don't fix structural imbalances. They don't create affordable supply. They don't reset valuations. They don't magically align prices with incomes. They delay recognition. And delayed recognition is dangerous because it pushes risk forward. The next phase isn't a dramatic crash. It's expectation collapse. It's the moment buyers realize lower rates won't save affordability. It's the moment sellers realize prices won't return to peak levels. It's the moment investors realize yields no longer compensate for risk. When that realization spreads, liquidity dries up quickly. Not because of panic, but because belief erodes. History shows this phase rarely makes headlines early. It shows up quietly through declining volumes, tightening credit standards, and subtle changes in lending behavior. By the time the story becomes obvious, the damage is already baked in. What makes this cycle more dangerous than past ones is generational. Previous housing downturns always had a steady stream of new entrants ready to step in when prices adjusted. This time, an entire generation has been priced out for years. Millennials and Gen Z aren't sitting on cheap mortgages waiting to trade up. They're standing outside the market entirely. That matters more than most people realize. Housing systems depend on first-time buyers. They're not just participants. They're the foundation of liquidity. Without them, price discovery becomes artificial. Stability becomes policy-driven rather than market-driven. Mortgage rates below 6% feel like relief. But relief without participation doesn't restore balance. It exposes fragility. And once that fragility becomes visible, confidence can evaporate far faster than policymakers expect. This isn't abstract. This isn't academic. This affects you directly. If you're a homeowner, lower rates don't guarantee rising values. They increase competition among sellers without guaranteeing new buyers. If you're a renter, lower rates don't mean lower housing costs. They often delay new construction to keep supply tight. If you're an investor, compressed yields mean you're taking more risk for less reward. And if you're a worker, housing stagnation feeds into job mobility, wage growth, and cost of living pressure. This is how macrofinance becomes personal. Not through sudden collapse, but through systems that look stable while quietly losing their ability to deliver opportunity. Mortgage rates falling below 6% should have been a turning point. Instead, they became a warning sign, a signal that the old tools are losing effectiveness, that confidence is being managed, not earned. Lower rates can delay pain. They can smooth volatility. They can calm headlines. But they can't fix a system where debt grows faster than income and prices detach from reality. History is unforgiving on this point. When intervention replaces organic demand, markets lose resilience. When capital seeks protection instead of productivity, growth slows. When confidence depends on constant support, fragility increases. Mortgage rates below 6% feel like good news. But they may be the calm before something larger. Not a crash, a reckoning. And the real question isn't whether that reckoning comes. It's whether you recognize it while there's still time to adapt.